Hey, Dan Passarelli here. How are you doing today? Oh, I am so glad that you are here because we've got something really great to talk about. This is a something that I put a lot of work into figuring out how to do, and it involves short squeezes, specifically how to find them before they pop. Now, before we get into talking about this, well, first of all, I'd like to make sure you can hear me. If you can hear me, please go to the Q&A box and just give me a big old yes. Please go to the Q&A box. Okay, NTIS. Yeah, you're back. I love it. I love it. All right. We got Shala, we got Rod, we got Peter and Bob. And Simon, you guys are awesome. Okay. Now, before we get started, I need to point out options are not for everyone, and you should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. And don't trade with money you cannot afford to lose. Very, very important. Plus, the information we'll be giving today that I'll be sharing is generalized information. I am not able to give you specific trade ideas because I don't know your specific situation. Now, for those of you, I see some familiar friends here, which is awesome. Nothing I like more than people who are all in on getting great at their trading. So I love when you come back again and again, but I think I see a couple of new folks here too. So let me introduce myself for just a moment. My name is Dan Passarelli, and I am an author of a couple of the top option trading books. Trading Option Greeks is the one that I'm very well known for. And I am a trader. I trade now in a retail account, just like you. But before then, I traded for years down on the floor of the exchanges, the Chicago Board Options Exchange, the Chicago Board of Trade, CME Group, stood down there in the pits on all of those exchanges. And I'm the founder of Market Taker Mentoring, which is the leader in option trader education. The global leader, we have students in well over 50 countries. Last time I looked, it was 50 countries. I'm sure it's more by now. And I get around the trading industry. I collaborate with top-notch options brokers like Firstrade, as well as pretty much all the options exchanges literally in the world. And get to be on TV a lot and all that kind of stuff. And I'm a family man. I'm married to my wife, Kathleen, who some of you who are long-term students at Market Taker, you know Kathleen. She runs operations here at Market Taker. And we have our 2 adult children. And I do some things outside of trading. I'm a runner, foodie, love to cook, love to eat, traveler, been all over the world, either as part of what I do for the options industry or with my family. And I'm also a music person. I like to listen to music, play it, the whole shebang. Now, let me skip this here for a second because I've got something even better for you. You're going to like this. Now, the first thing you have to know is that in order to find these short squeezes, we have to understand what a short squeeze is, right? And in order to understand that, we first have to understand what short selling a stock is. In a minute, I'm going to give you a crash course, but before I do that, I want to give you something really, really special. So I wrote a strategy guide on how to identify and trade short squeeze stocks. This gives you the whole strategy behind some of the biggest historical gains, literally of the past decade. So that strategy guide is designed to go along with this training today here, with this webinar, not to replace it, but please go now. And here, maybe I can just type this into chat, everyone. So we'll go markettaker.com/squeeze. I forget if you have access to the chat box. I think you do. If not, just type that into your browser, market taker, market like stock market taker, like take what's rightfully yours, 2 T's in a row, markettaker.com/squeeze, and grab that strategy guide to read later. All right. So let's start out talking about short selling. So short selling, or simply shorting, is when a trader borrows shares of a stock and then sells them to someone else. And you just do this through your broker. I mean, it's all sort of what we call in the business handled by the back office. We just simply click sell short and boom, they borrow the stock from somebody, put it into our account, and we sell it to somebody else, and that all happens within like a second. Now, short sellers make money by buying the shares back later at a lower price than they sold them. So, you've heard people say, oh, buy low, sell high, right? Well, this is that, but we're just reversing the order. We're selling high and then buying low later. So that sounds easy enough, but there are some risks to short selling. First, we need the stock to go down because we need to buy it back at a lower price later, right? So if the stock rises, traders lose. And here's the rub. Worst case scenario, the stock can only fall to be zero, become worthless. But to the upside, stock prices can theoretically go up to infinity. There's no upward limit. So, at least in theory, there's much greater risk to shorting a stock than owning a stock. So shorting is by nature a leveraged trade because when we buy a stock, we pay for the stock. If it's a $100 stock and we buy 100 shares, we're going to pay 100 times 100, $10,000, and we own those shares. We can leverage it by buying the stock on margin, by borrowing from our broker up to 50% of the value of the stock. But with short selling, we're literally not paying for the stock. I mean, in fact, we're literally collecting money when we sell the stock, which just kind of sits in our account as cash. And, we have to put some of that aside for margin, but it's a very, very small amount. A lot of times that can be around 15% of the value of the stock. So it is by nature a leveraged trade. It has to be. So that brings us to short squeezes. A short squeeze is when a lot of the outstanding shares of the company have been shorted. And this could all be mostly by one trader who's just short a bunch of it, like, a big professional trader institution. Or it could be by many traders, one institution, 3 trading firms, a bunch of retail people, doesn't matter. So here's the thing. When a lot of people are short shares, what they do is they want the stock to go down, but if it goes up, they have to manage that risk. How do you manage risk when a trade goes against you? And that's an important question, isn't it? I think a lot of novice traders just think, well, I don't know, I hope it stops going against me. But professional traders got to be professional traders because they got good at managing risk. And that being said, when trades go against professional traders, they've got to cover that risk. If they're short it, they've got to buy it back, right? Because professional traders have investors to answer to. They just can't sit around and say, I don't know, I hope it goes back down and I don't lose more. They've got to cut those losses short. So when the stock starts rallying higher, the people who are short it, the short sellers, they're forced to cover or buy the stock back to limit their losses, keep their losses small. But that buying pressure, remember, they're short a lot of the stock. That drives the stock price higher, creating even more buying pressure. And sometimes it can create this, like, cause and effect whirlwind thing where more and more pressure is created. So let's talk about how to do this. To find short squeeze candidates, first thing we have to do is identify stocks with high short interest. Then we're going to take those stocks that have high short interest and we're going to cross-check them against the company's profitability. Then we're going to look for unusual activity or a high volume of out-of-the-money calls being purchased. We also may look at what we call reverse call skew, which is a more advanced topic, but that's basically the implied volatility, which is a measure of demand really for options. The implied volatility of the calls compared to the puts is higher, which shows high demand for calls. And if all that coincides with the stock rising from a base, now we've got something powerful. So let's break each one of those steps down and talk about how to do this. So we can identify high short interest pretty easily. We just go into our Firstrade account and we type in the stock symbol. In this case, stock symbol is HP. And we have to scroll down a bit and go to trading information. And then right here, we see the short percent of float. Now, some of these words might be new to you, and let me just explain what they all mean. So let's work backwards. Float. Float is the number of shares that are available for trading. So when a company becomes a corporation and issues shares of ownership with their IPO, initial public offering, what they do is they take these shares, they used to be pieces of paper, now they're just, electrons, and they sell each share to the general public. And then, it trades on the market, right? You know how that goes. Now, they do keep some of the shares, like, in their own account, like the company itself may own some of the shares. So only the shares that are available for trading are what we call the float. Now, high short interest is when at least 15% of the company's stock is shorted. And that's kind of a hard line in the sand figure. I've looked at short squeeze candidates. I've made this one of my areas of expertise over the past few years. And once we get down below 15%, you just don't see those short squeezes play out. Once it's above 15%, yep, it can be a good candidate, but we need to look at more criteria. So then we cross-check our list of short squeeze candidates against how profitable the company is. And look, you don't have to be a financial expert here. There is some subjectivity, but generally we look to see that the company's making money. And there's a number of ways to do this. And again, if you're not familiar with some of the terms here on the slide or that I say, don't worry. I'm going to break it down as much as possible. And at the end, we're going to have a little Q&A session. So you can find this information right there on your Firstrade platform or on a lot of financial websites. So first of all, one of the things we want to look at is the price to earnings ratio. Because what's one reason why someone would short a stock? Well, somebody might short a stock because they think it's overpriced. It's one reason. Another reason is because they think, it might go out of business. But a price to earnings ratio of 10 is pretty low. That's a pretty cheap stock relative to their earnings. For example, the S&P 500 as a whole, for those of you who are watching this live, their PE ratio right now is about 27, which is actually pretty historically high. But so we look for a low PE ratio, and we look for free cash flow. This is how much cash the company is bringing in, right? This is $227.824 million. We like to see, as long as we're seeing a positive cash flow, that's good news. And then, there's some other metrics that you might want to take a look at. We don't want to have too much debt to equity, et cetera, et cetera, et cetera. Now, next, we look for what is referred to as unusual activity. We're looking for big trades that happen that are out of the ordinary, that indicate what other traders are doing in the market, and see if we should follow along. Now, this is the trickiest part of all of this. So many people oversimplify this part and they get frustrated because they can't make it work. We're looking for very specific data. Now, most amateur traders, they only look for volume. But we have to take it even farther. In addition to volume, the trade must be an opening transaction, right? Because if you see some calls trade, that could be somebody who bought those calls a month ago and now they're closing them out. We also need to verify that it's only a buying transaction. If you see 1,000 calls trade, that could be somebody who works at an institution. That could be somebody who works at an institution who is selling a bunch of covered calls. So we need to make sure that it's a buying transaction only. Now, sometimes the stock is a buying transaction, but maybe they're selling a different call against it. Or maybe they're buying a put against it. It's part of a straddle or a strangle. We need to be looking for people who are just buying calls. Now, the next thing is we prefer what is called a sweep. So a sweep is when somebody just comes in and buys a crap ton of calls all at once, and they're not trying to middle the market to negotiate the price or anything like that. They're just lifting the offer and buying it on a whole bunch of exchanges all at the same time because they're in a hurry to get it done. That's a big sign that the trade is probably more imminent. And the important thing is, in order to make this work, it's important to get into the trade reasonably shortly after these big trades are happening. Also, later, I'll share how you can get alerts so that you don't have to sit in front of your computer all day waiting for these trades to show up. And I'll just tell you right now, the way you do that is when you go to grab this, how to identify and trade short squeeze stocks. It'll put you into, you'll get a couple emails after that share exactly how you can get alerted to some of these. All right, next. The fourth thing is that all this coincides with the stock rising from a base. And look, you can see the base, like there was basically two short squeezes on this one. We see here, the stock is kind of going down and it's sitting there for a couple of days, and then it starts rising a couple of days here, right? Kind of see the same thing over here. It's kind of sitting there, sitting there, sitting there, and then we get this up day, and then boom, it really takes off. So, like you can see how these tend to play out just over a couple of days. So realistically, you do have some time to get in, right? Sometimes you see this thing starting to play out, and even if you don't get in it today, you get in it tomorrow. A lot of times you can still capture these. But, one of the tricky parts is, while you don't have to get it perfect, you don't want to be too slow on the strategy, because this one, well, it did kind of continue playing out, but then it came straight down and then eventually just like really ended up back below where it even was before that. Now I'm going to show you some other examples in just a minute where they can reverse either the same day or the next day. So the timing does not have to be perfect, but we want to make sure that we're seeing these trades when they are happening. So this is kind of a somewhat unique strategy we use trading these short squeezes. And it's sort of the same strategy that Muhammad Ali used to defeat George Foreman in what has been called the greatest sporting event of all time, the Rumble in the Jungle. So George Foreman was known for not just the George Foreman grill, but known for power, right? And Muhammad Ali was known for speed. Now, this fight was a long time ago, right? I'm not just dating myself. I had to actually look up a couple of facts on this here, right? To be fair. So you might not know this, but Muhammad Ali going into this fight was the underdog. He actually had 4-1 odds, Vegas line, against him winning the fight. So he came up with what he called a secret strategy. Didn't even tell his manager. And it's the same secret strategy that I use in trading short squeezes that I'm going to share with you now. So Muhammad Ali knew that the way to win was to wear Foreman down and wait for his opportunity. So he backed up on the ropes and covered his face and let Foreman hit him, delivering a lot of small punches that did very minimal damage. And then when there was an opening, Ali would attack. Small little losses for not much damage, and then boom, scoring some big points. The fight only lasted 6 rounds when Foreman got knocked out. Muhammad Ali's strategy, that he later referred to as rope-a-dope, worked. Now, this is a very common strategy in trading. Some of the best traders of all time do this exact same thing. Nicholas Nassim Taleb is famous for using this strategy. And there were a father and son team of traders that I used to work with on the trading floor that used this strategy. And we use it in our short squeeze trading as well. The idea is that, we'll have several trades that don't work out, but we'll have very small risk, very small losers. But the one that takes off can make up for the losers many, many, many times over. So this is classic trading 101. Keep your losses small and let your profits run. And timing plays into that, as you can see here too, right? So like here's one we got a base, we've got this update, and then housies, we end up like opening way higher. And it pulled back this day, but then up the next day, and then down, down, down. So like if you got into it here, you might have taken a small loss. But then if you get into it here, bam, that way more than makes up for the small loss. So what is possible trading short squeezes? Well, let's talk. Highly leveraged profits resulting from huge up moves in the stock. And because we specifically use options, we follow along what I call the smart money. These people who see this happening and get in before it, that creates the snowball effect, because other people see people buying calls and they buy calls, and that drives the stock higher. Because why does the stock go higher? Well, the stock goes higher because people buy it. Okay, so what does that have to do with options? Everything. When somebody buys calls, like, okay, who's one of our regulars here? Hold on a second. Who's one of our regulars here? How about NTIS? One of these days you got to log in with your real name. NTIS is just like, it's funny to say as a name. Okay, so NTIS goes and buys 10 calls in some stock that he or she thinks is going to short squeeze. Who is that stock being bought from? That stock is being bought from a market maker, who is somebody who trades on the exchange and provides liquidity. When you see those offers, you log into Firstrade and you see bids and offers on all these different options. Those are market makers' bids and offers. So you're buying these calls from a market maker. Now, who can tell me this? I think we got some smart folks in here. Who can tell me this? When a market maker sells you calls, what is the first thing the market maker does? Hit that questions box. I want to see who's doing. I want to see who knows. When a market maker sells you calls, boom, Catherine, how? I should have known it was going to be you. All right, Catherine's been to a number of these webinars. She knows what's hip. That's right. As soon as the market maker sells calls, which gets short deltas, the market maker buys stock to get long the equal number of deltas. That's called delta hedging, or getting delta neutral. So, this is kind of interesting, isn't it? When the public buys calls from market makers who sell them, market makers buy the stock. So call buying can drive the stock price higher. Make sense? And so that's part of it. So when people are buying calls and other people like you and me see this happening, they say, oh, people are buying calls. I know this is a short squeeze candidate. I'm going to buy some calls too. Market makers are selling calls, buying stock, buying stock, buying stock. The stock is going higher and higher because of the call buying and consequent hedging. And then people who, trade charts, they look for momentum trades. They say, oh, look at this. The RSI is rising, or we're going through a moving average, or we're breaking above resistance. There's my buy signal. Time for me to buy. Drives the stock even higher. Now, the people who trade short squeezes, what are they doing? They're wiping their brow. They're fidgeting, biting their nails, and saying, oh, crap. Here's my stop loss. Boom. They get stopped out and they buy back that stock that is short. And they're not buying back 100 shares. or 1,000 shares. They're buying back 10,000 shares, 50,000 shares, 100,000 shares. Massive buying pressure. We see more call buying because of that. We see more momentum stock buyers. Then we see more short squeeze covering. And we get this massive snowball effect. Snowballs don't really run uphill, but you know, I don't know. I don't know what an example is. I don't know what an example is of something that goes uphill like that. But hey, what are we going to do? Okay. So that being said, we can see some highly leveraged profits resulting from huge up moves in the stock. And so we can frequently find these trades. Like these happen. I created actually a scanner that finds these, and we get them every single day. Sometimes we'll get, 10, 12, 15 different signals a day. Now, I, of course, screen them and cherry pick them and only take the strongest and the best of them. So it's not like I trade these every day, but we frequently find these trades and frequently find good trades. Now, one of the best parts of this is that it's very easy to manage the risk. These are very, very straightforward trades. Most of the time, not all the time, but most of the time, what we're doing is we're buying calls just like we see. If somebody's buying, we see that 1,000 of the 6 strike calls that expire next Friday traded, we're probably buying those same ones. When we're just buying calls, it's very easy to manage. As soon as I get filled on a long call trade, I do, well, one thing, but it's 2 parts to that one thing. The first thing I do is I put in a limit order to sell those calls, or at least to sell half of those calls. That's typically how I do it. I put in a limit order to sell half of those calls at a profit. And I'll usually aim for anywhere between 50 and 100% profit. Now, you might think, hey, isn't that being pretty greedy? Like, don't you want to be more conservative and lock in more winners? Yes and no. Remember, this is the rope-a-dope type strategy, right? We know that we're probably going to have more losers than winners, but they're just going to be little tiny losers. I'm going to get to how we manage that in just a second. But the ones that take off, we're not looking to make 20% or 30% or 40%. We're looking for some of these big, massively leveraged moves that can make up for 20, 30, 50 little tiny losses, and then some. So even if we win 1 out of 10 times, we can be in really, really great shape. So first thing I do is set a limit order to sell half of the trade at a 50 to 100% profit. And I do that good till cancel, or good till 90 days. And at the same time, I put in a stop order to sell those calls if it goes against me. And I'll put that in if it goes against me, like, 20% or 15%, depending on the width of the bid-ask spreads. If the bid-ask spreads are wide, I might, instead of putting in a stop order, I might instead decide to just put in an alert, where if the stock goes down a certain amount, ends up down on the day or something, then it'll send me an alert, or I'll just check it throughout the day. And if it's down, then I'll close it out. If I'm using a stop order proper, I'll set that good till cancel, just like the limit orders, good till cancel or good till 90. I'll put them in OCO. One cancels the other. So if one gets filled, it cancels the other. The reason I do that is because sometimes, when there's a lot of volatility, especially if the stock goes down, you get stopped out and sell the calls, but then it ends up going back up, and next thing you know, you're short the calls. So you always want to do that OCO. And then remember, that was for half the position. The other half of the position, I'll either manually watch or I'll put in another limit order to sell it for like a 200 or 300% profit. And then maybe put in a stop order. You know, if I get filled at a 50% profit, then the stock's already higher. So my stop order would be set to still take a profit. Just if it falls down a little bit, you know, be a profit of not 50% where it is now, but, you know, maybe 30%. And I'll do that, maybe do those good till cancel and maybe OCO. All right. So let's talk here a little bit about realistic expectations. It's super easy to find these, all right? I mean, especially if it's just scanning the market. What we always want to do is we always want to cherry pick a little bit. So we won't take every trade. There are some where we get these signals on a regular basis and it's like, I've seen this happen before. But then there's some that, you know, you see these things play out often, you know, like this one. This one had really 3 short squeezes within a 6-month period. Goodness gracious. I mean, come on, right? So you get to recognize them and you get really, really good at this. Our win rate times our expected return is our long-term profit. So like, you know, a lot of times people get super hung up on the win rate. They say, oh yeah, you know, this strategy has an 80% win rate. This strategy has an 86% win rate. Well, okay, whoop-de-doo. What if it's one of those where every time you win like, you know, $5, but every time you lose $1,000. Like, you don't want that. Well, this is the opposite of that. You're likely to have a lot that don't quite bust through, and then you have to sell it and take this little tiny loss. And then same thing, you get in, it doesn't quite bust through, and maybe you just break even. Another one doesn't quite bust through, a little tiny loss. Another one doesn't quite bust through, little tiny profit. And then another one, and bam-o, really bust through. And then, you know, these 4 or 5 or 6 or 10 trades, whereas like you're really just treading water, you know, lose a tiny bit, bam. Then you get that really, really great one where it pays off. So it's kind of like I don't know what's with me in sports analogies today, but it's kind of like the Babe Ruth style of trading, right? Babe Ruth, you know, for those of you who are baseball people, which I'm not, I just know a lot of useless information. He at one time had both the highest strikeout in the league as well as the best home run stats in the league. Seems counterintuitive, but it's true. You know, it's kind of swinging for the fences. You're going to get a lot of strikeouts, but you're going to get home runs too. So you take that win rate times the expected return. So expected return is like, if I expect to lose $50, you know, per contract on my losers, but I expect to make $500 on my winners. Just multiply that, like, okay, if I lose 5, I lose $250. I win 1, I win, what did I say, $1,000 or whatever? Okay, there's my long-term profit. Win rate versus expected return. And then we want to set a baseline for sizing our trades. I mean, look, with a swing for the fences type strategy like this, I mean, goodness, wouldn't it be just wonderful to, like, you know, bet the farm and be right and, you know, you make $1 million. Well, sure, but that's not realistic. You don't want to do that. All good trading is about consistency. And this is a consistent strategy, long run strategy. where we're looking for long-term profit because of expected return balanced against that win rate. So we want to set, you know, we want to make trades where we allocate a fixed controlled amount of capital to each, and in the long run, grind out profits, right? And the profits, again, there's variance within that graph. I mean, your profit graph over time is going to, be like this, all over the place. But in the long run, you grind out these profits, and if you keep the trades small and make them on a regular basis, this is how we get consistency. And, another great thing with this is it's nice to have fun with it. This is a really fun system for trading. When you get those home runs, it's really, really exciting. And when you don't, it kind of feels good to know that you're trading with that discipline to manage your risk. It just makes you better at all your trading. Now, I'm going to open this up to questions in just a second. But you may be wondering where to find me. Well, you can find me on youtube.com. Just go to Market Taker Mentoring, all one word. Instagram, Market Taker Mentoring, all one word. Facebook, Market Taker Mentoring, all one word. Or you can follow me personally on X, formerly Twitter. And if you've got one of these, just open it up, go to the camera app, and hover over one of those, they call them QR codes, and a little yellow box will open up below that. Click that, and you can just follow me right there on your phone. Explaining that in case you've never used QR codes. So go ahead and pop your questions into the questions box. And in the meantime, don't forget, go to markettaker.com/squeeze, markettaker.com/squeeze, and grab your free strategy guide. All right, what questions can I answer for you on short squeezes or anything else that we talked about today? What question can I answer for you on short squeezes or anything else we talked about today? Anything at all? Catherine, there we go. Catherine says, what are the differences when it goes the other way? A long squeeze? Well, not really. I mean, they don't call it a long squeeze, but there is something similar to a short squeeze called a gamma squeeze. And short squeezes can be affected by gamma squeezes. Those can go either way. And we actually had one of those in the broad market on, I want to say it was August 6th of 2024, I think, where, there's a lot of funds out there that have short volatility, short options, which gives people what's called negative gamma. And for little moves, market sells off 0.5%, 1%, 1.5%, no big deal. You don't see any of that. But when you see the market pull back like, 3, 4, 5%, those funds, they also trade delta neutral. They end up getting longer shares the more the market falls, which means, or I should say longer deltas the more the market falls, which means they're losing exponentially as the market continues to fall. And so the only way that they can deal with that is they have to sell shares to hedge those long deltas, which in a falling, these are big funds. In a falling market where people are already selling shares and they have to sell shares just to get long deltas, that can happen. Does that happen in individual stocks? Maybe yes and no. Some of the big ones, maybe. But in the broad market, you do see those gamma squeezes that can be bullish or bearish, exacerbating moves. Really good question, Catherine. Peter, Peter, grab that ebook, okay? Grab that ebook or strategy guide, I should say, markettaker.com/squeeze. And I'm sending that as a response to you, so you can just click the link. And I think anybody should be able to click the link since I typed the answer. Because I don't open my trading platform during these presentations because I've done it before, and sometimes like, oh geez, well, what about this stock? Oh, that doesn't work out, and it makes for a less educational presentation when I'm winging it live real time. WK, looking for a minimum 15% shorts in a stock. Is that of the float? Yes. So specifically, take the float, which are the available shares for trading out there. And if 15% or more of the float is shorted, that's one of the criteria we're looking for. And you can get that right on your Firstrade platform, or there are websites out there where you can get that information as well. Catherine, other than the obvious buying puts, in order to how to trade those gamma squeezes. Yeah, I mean, it's tricky because once that starts happening, the implied volatility gets really high. So those puts get really super expensive. So you got to be pretty nimble on that. I'll tell you what I do with those a lot of the times, Catherine, is I wait for what's called capitulation. And when we see that gamma squeeze to the downside happening and people are selling, and people start panic selling, I wait until it's just starting to turn around. And there's risk to this strategy, then I sell put spreads or puts if it's in my IRA and I want to buy shares for the long term. So I wait until it looks like the market's going to bottom out. And full disclosure, you're never going to call it exactly right. I actually, during coronavirus, right? The big sell-off in 2020 in the spring, I actually was sitting on some cash, fortunate position, right? More lucky than smart for sure. And as the market started going down and down and down, people were panicking, and the implied volatility got higher and higher, I sold puts. And I'd love to sit here and tell you I sold all my puts right at the bottom of the market and it was perfect, but that's not what happened. I sold them here, and I sold more here, and I sold more here, and I sold more here, and then it went a little lower. But then ultimately it all came back. And so I ended up average pricing pretty good. So that's my strategy for trading those. Shalab says, where can we find the short squeeze stocks on the Firstrade platform? Just go, I don't have it open and I don't want to start pulling things up live, but just type in the stock symbol and then scroll down. You got to scroll down pretty far on the page until you get to this part, and then click on trading information is where you get the float. Where can you get the short squeeze stocks on the Firstrade platform? As far as a list of short squeeze stocks, I actually, for me and for our customers who trade these and use our scanner, me and my team actually curates a basket of them manually. And we go through where are they? These 4 steps manually. It takes hours and hours and hours. We do it every couple of weeks so that we curate a basket manually. There's not a place where you can get stocks that have just these, that meet all this criteria. And really, it's just the first 2 steps. Then we look for the unusual activity when the stock's rising from a base. So, I mean, again, I would say your best bet is to download that, and we'll send you an email or two with some further information of how you can get that curated basket and such. Good question. Peter says perhaps use the top stocks listed on high short interest stocks. Yeah, I mean, on top of that, there are some websites out there. Highshortinterest.com maybe is one of them, but yeah, you can find some stocks, and they update it on a pretty regular. Well, they update it, I believe it's once every 3 weeks, because that's when companies are required to update their list, or exchanges rather are required to update their list. How to stop loss down 50%, sell all calls. Lita, no, it's you need to keep the stops tighter. And first of all, you only use a proper stop, like an actual stop order, if the bid-ask spreads are very tight. Otherwise, you have to set an alert or a mental alert, or just check it a couple of times a day and put in the trade manually. Because remember, when you use a stop, it's going to fill on the bid. And if the bid-ask spread's very wide, you end up getting a really bad price. So, but it's more like 20%. Peter, is it possible to short more shares than the available float, correct? Isn't this what happened with GME? Yes, it is possible to do that. The powers that be, SEC and such, have tried to put in some safeguards since then to try and make that not happen, because some of it has to do with the timing, because back then there was a 3-day settlement process. So if you buy or sell stock, like, you have it, but it's not actually yours fully until 3 days afterwards. They changed that and shortened that time period. And that was one of the reasons, because people were shorting the stock, and, it was just sort of in no man's land for 3 days. And so they didn't really know how much was shorted, and there would be more borrowing than whatever. Plus, I imagine, Peter, I could borrow 100 shares from you and sell it to somebody who now owns it, who then lends that stock out to somebody else too. I think that's one of the things that can happen too. How do you factor in the short ratio, if at all? Oh, that 15% ratio? That's just the cutoff line. When I curate the basket of short squeeze candidates, if it has less than 15% short interest, I don't add it to my basket. We just had one yesterday, Siri, SIRI, that was a good candidate for a while, and it was rising. And I was like, oh, that's one that I know is on our basket. It's rising. It's a cheap stock, rising from a base, a lot of call buying. This must be a short squeeze. Let me look at it. And then I noticed the short interest rate, the short interest was only like 4%. I was like, oh, it doesn't have all that short interest anymore. What's going on? And it turned out that somebody was buying it, Berkshire Hathaway or somebody. So it wasn't a short squeeze, and I decided just to skip it. Shilab, you're welcome. Catherine says, when looking for short squeeze potential stocks, do you consider undervalued sectors? And is there a market cap preference? I don't consider sectors at all. What I really want is for good stocks that somebody has a bee in their bonnet and is shorting. Like GameStop really was a pretty classic example of that. People, there were some short sellers out there who were like, wait, brick and mortar games are being, displaced by, just buying the games online. Like Microsoft switched to a system where you didn't have to go to a brick and mortar store anymore. You just buy the game right there on your console. And so they're like, yeah, well, this is no longer a good business model. But then Roaring Kitty saw it as a potential to change the business and, blah, blah, blah. There's a whole big long backstory there. And he thought that it was a solid company still and had some merit. And that's really what you're looking for. You're looking for that anomaly, that walking the tightrope where there's some people who are shorting it, but it shouldn't be shorted. And so that's why you look for a low PE ratio. You look for companies that are actually making money, but just that, somebody for, sometimes it's even like, I don't want to say like political motivations, but they just sort of fade. They fade the rationale for a reason that might not be fully an economic reason. William, does your market taker company offer a subscription for the basket of short squeeze candidates? Yeah, it comes with a package. And like I said, if you go to markettaker.com/squeeze and download this strategy guide, we will send you a couple of emails that invite you to a webinar or a video that explains how it works and lets you subscribe. So, yeah. Peter says, do you consider any of the short squeeze meme stocks, or do you stick strictly with the fundamentals? In other words, do you scan Reddit for any insights on a particular trade? I have done that in the past, but it's like any other game that has a lot of sophisticated players. With the stock market, people always get a step ahead of you. So back in the day, it used to be really useful to scan Reddit for them, but now there's a lot of, well, I mean, there still is good information on there about short squeeze candidates, but there's a lot of bozos too now. And there's a lot, and you come across some scammers, some pump and dump bozos. So it's harder now. So I tend to just stick to the numbers these days. But I don't rule it out. Sometimes if I come across one from a mode or a medium like that, I will add it to the basket. All right, folks. Thanks for joining me. Have a great rest of your day. And I will see you next week when we talk about how to protect your stock investments before the election using puts. This is Dan Passarelli. Trade smart. Catch you next time. You're welcome.